Of all the principles that constitute the science of speculation, none is more vital and none more universally neglected by the public than the art of managing losses. The average man comes to the market with his mind fixed solely upon the profits he hopes to make. He dreams of the 10, 20, or 50-point gains that will secure his fortune. His focus is entirely on the reward. The professional operator, by stark contrast, begins his every calculation from the opposite end of the equation. His first and most pressing thought is not how much he can make, but how much he can afford to lose. Richard Wyckoff observed this fundamental difference throughout his long career on Wall Street. He saw that the public's failure was not primarily a failure of stock selection, but a failure of capital management. They did not treat trading as a business. This video is a deep dive into the foundational rules that Wyckoff established for managing capital and, most importantly, for preserving it. It is a guide to the single most critical tool in the trader's arsenal, the stop-loss order. We will explore not just the mechanics of where to place a stop, but the profound business philosophy that makes its use non-negotiable for anyone seeking long-term success in the market. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. The cornerstone of Richard Wyckoff's entire approach to capital management is a single powerful idea. Rule number 1, make trading a business or do not engage in it at all. He saw that the vast majority of people who lost money in the market were not defeated by the cunning of manipulators or by some inherent difficulty in forecasting prices. They were defeated by their own amateurish approach. A successful merchant would never start a business without a detailed plan, a thorough understanding of his goods, and a strict accounting of his expenses and potential losses. Yet this same merchant would come to Wall Street and risk thousands of dollars on a whim, a rumor, or a hopeful guess. To treat trading as a business, in Wyckoff's view, meant embracing a set of disciplines that were entirely foreign to the average speculator. It meant, first and foremost, a period of serious preparation and study. He himself, as we have discussed, spent 8 years studying the market before making his first investment, and another 6 before he began active trading. He understood that knowledge of market technique was far more valuable than capital in the beginning. Without knowledge, capital is merely fuel for the market's fire. It also meant developing a clear and logical method of operation. A businessman has a process for buying inventory, pricing his goods, and selling them. A trader must have a similar process for identifying opportunities, entering positions, and, most critically, exiting them. This method, based on the analysis of supply and demand, is what separates the professional from the gambler. Furthermore, treating trading as a business meant keeping meticulous records of every transaction. The professional trader must be a scrupulous bookkeeper. He records his trades, his reasons for entering them, and the results. He then studies his losses with even greater intensity than his profits. A loss, when properly analyzed, is not a failure. It is a lesson. It is tuition paid to the market for a piece of valuable education. The trader who does not learn from his mistakes is doomed to repeat them until his capital is exhausted. This constant process of self-examination and refinement is the hallmark of a true professional. From this central idea of trading as a business, all other rules of capital management naturally flow. The first and most destructive habit that a business-like approach must eliminate is the one Wyckoff saw as the primary cause of financial suicide on Wall Street. This is rule number 2. Never overtrade. Overtrading is a ruinous practice that manifests in 2 ways. Trading in quantities that are too large relative to one's available capital, and trading too frequently with no sound reason for each commitment. The man who overtrades is acting not from a position of calculated analysis, but from a position of greed and impatience. Wyckoff observed that the average man with $10,000 in capital wants to begin by trading in 500 or 1,000 share lots. He wishes to start at the top, and inevitably, he works his way down. It is only a question of time before he is forced to trade in 100 share lots, and then in 10 share lots, as his capital is eaten away by losses that are too large for his account to sustain. The professional, Wyckoff noted, does the opposite. He begins with small commitments, testing his judgment and the market's temper. He increases his trading size only as his capital is built up out of profits. To overtrade is to place oneself in a state of constant financial and emotional vulnerability. A single unexpected move can cause a crippling loss, wiping out the gains of many successful trades and severely impairing one's ability to continue. It destroys mental poise. Fear becomes the dominant emotion. A trader who is risking too much on a single trade cannot think clearly. He will be swayed by every minor fluctuation. He will close out a profitable trade too soon out of fear of giving back a small gain, and he will hold on to a losing trade for too long out of a desperate hope that it will come back. Overtrading is the enemy of clear judgment, and clear judgment is the professional trader's most valuable asset. The correct approach, Wyckoff taught, is to trade in amounts that are small enough to ensure that the outcome of any single trade is of no great consequence. This allows the trader to remain calm, objective, and focused on the correct application of his method rather than on the money involved. With the foundational principles of a business-like approach and the avoidance of overtrading in place, we arrive at the most critical, practical tool for financial survival. This is rule number 3. Always limit your risk. For Wyckoff, this was not a suggestion. It was an ironclad law. The active and unwavering limitation of risk, he believed, was the single greatest factor that separated the successful professional from the chronic loser. The mechanism for achieving this is the stop-loss order. The philosophy behind the stop-loss is simple but profound. It is the explicit recognition that you can and will be wrong. No matter how thorough your analysis or how strong your conviction, the market can always prove you wrong. The stop-loss is your predetermined plan for what you will do in that event. It is an insurance policy against a catastrophic loss. Wyckoff used the analogy of insuring a house against fire. A prudent man does not fail to insure his house because he does not expect it to burn down. He pays a small, known premium to protect himself from the devastating and unknown cost of a potential disaster. The risk on a trade, the distance to your stop-loss, is that small, known premium. To trade without a stop is to leave your entire financial house uninsured, vulnerable to the first unexpected fire. The public consistently reverses this logic. They take a small profit out of fear, but they hold a large loss with hope. The professional does the exact opposite. He must fear that his small loss may develop into a much bigger loss, and he must hope that his small profit may become a big profit. The stop-loss is the tool that institutionalizes this professional mindset. It is a mechanical and unemotional execution of a business decision made when the mind was clear and objective before the trade was even entered. E.H. Harriman, the great railroad magnate whom Wyckoff studied, began his career as a floor trader and was known for his mastery of risk. He once said, "If you would be a successful trader in stocks, kill your losses." The stop-loss is the instrument with which this is done. One of the greatest obstacles for the novice trader is overcoming the psychological pain of having a stop-loss order triggered. It feels like a failure, a small but stinging defeat. Wyckoff taught that this perspective is entirely wrong. The successful execution of a stop-loss is not a failure. It is the successful execution of your risk management plan. It is a victory for your discipline. When a stop is hit, it simply means that your initial judgment about the stock's immediate direction was incorrect. The stop-loss has done its job perfectly. It has cut the loss short, preserved the vast majority of your capital, and allowed you to step aside with a clear mind, ready to analyze the market anew and wait for the next, better opportunity. The trader who moves his stop-loss order to accommodate a growing loss, hoping that the market will turn, has abandoned the realm of business and entered the realm of pure destructive gambling. He has replaced a logical plan with a desperate hope. and in the stock market, hope is a certain path to ruin. This leads directly to the final foundational rule of capital management, a principle that ties the concept of risk directly to the potential for reward. This is rule number 4. The anticipated profit must be at least 3 times the risk. This rule is not about predicting the future with certainty. It is about playing the probabilities in a way that ensures long-term profitability. It is a simple yet powerful business principle. Wyckoff understood that trading is a game of averages. No trader can be right every time. Losses are an inevitable and recurring part of the business. Therefore, for the business to be profitable, the average profit on the winning trades must be significantly larger than the average loss on the losing trades. The 3-to-1 reward-to-risk ratio is the minimum standard that makes this possible. Before entering any trade, the Wyckoff analyst must perform 2 calculations. First, he must determine his risk. This is done by identifying the logical point for his initial stop loss, a topic we will cover in great detail. The distance from his entry price to his stop-loss price is his defined risk on the trade. Second, he must determine his potential reward. This is done by using a logical method of analysis, such as the point and figure counting technique, to project a reasonable price objective for the move. If the potential reward is not at least 3 times the initial risk, the trade is simply not taken. This discipline has a profound effect on a trader's results. It forces him to be patient. It compels him to wait for the very best opportunities, the A-plus setups, where a stock is poised for a significant move from a point where a very close stop can be used. It eliminates the temptation to trade on low probability, marginal setups where the potential profit is small and the risk is ill-defined. By adhering to this rule, a trader can be right on only half of his trades and still be handsomely profitable. Imagine 10 trades are taken. 5 are losing trades, and each one hits its 1-point stop loss, for a total loss of 5 points. The other 5 are winning trades. Because of the 3-to-1 rule, their average profit will be at least 3 points, for a total gain of 15 points. The net result is a profit of 10 points. This is the simple, powerful mathematics of professional speculation. It is the application of sound business principles to an endeavor that most people treat as a game of chance. It is the foundation of financial survival and ultimately of consistent success. Having established the fundamental philosophy behind the stop-loss order, that it is the ultimate tool for capital preservation and the bedrock of a professional, business-like approach to the market, we now transition from the why to the where. Understanding that a stop is crucial is the first step. Mastering the art and science of its correct placement is the second, and it is a skill that separates the novice from the expert. A properly placed stop is not a random guess or a measure of one's personal pain tolerance. It is a strategic decision based on the market's own testimony. It is placed at a logical point on the chart that has a direct and meaningful relationship to the reason the trade was initiated in the first place. The first principle in learning how to place stops correctly is to completely reject the arbitrary stop. The average speculator, if he uses a stop at all, tends to place it based on an arbitrary figure. He might decide to risk 2 points or 5% on every trade, regardless of the stock's character or the market's current structure. Wyckoff taught that this approach is fundamentally flawed. The market has no knowledge of and no concern for a trader's personal account size or his predetermined risk percentage. A 2-point stop may be far too wide for a quiet, low-priced stock, leading to unnecessary losses, while being far too tight for a volatile, high-priced leader, causing the trader to be shaken out by normal fluctuations. The core principle of Wyckoff's placement strategy is this. The stop-loss must be placed at the one point on the chart that conclusively invalidates the original reason for entering the trade. This is a profound shift in thinking. A trade is not proven wrong simply because a certain amount of money has been lost. A trade is proven wrong because the market's subsequent behavior has demonstrated that the initial thesis, the logical case for the trade, is no longer valid. The stop loss, therefore, is not just a financial backstop, it is a technical one. It is placed at the danger point, the price level that, if violated, signals that the underlying technical conditions have changed, and that the trader's initial analysis was incorrect. The art of placing the stop, then, is the art of identifying that precise danger point for every trade. Let us now delve into the specific technical method for placing these logical stops. We will first examine the rules for placing stops on long positions, which are trades initiated with the expectation of a price advance. In every case, the stop is placed just below a valid point of technical support. The definition of valid support changes depending on the context of the trade. We will begin with the most opportune moment to buy, at the end of a period of accumulation. One of the most powerful buying opportunities, as we have discussed, occurs after a spring or a shakeout. This is the final manipulative drive below the support of a trading range. When a trader buys in confirmation of a spring, that is, after the price has recovered and moved back into the trading range, the stop-loss order is placed at the most logical point possible, just below the extreme low of the spring itself. The reasoning is perfectly clear. The thesis for the trade is that the move below support was a false move, a bear trap, and that the composite man has now taken control. If this thesis is correct, the price should not return to that extreme low. A subsequent decline that violates the law of the spring would invalidate the entire thesis. It would indicate that the initial move was not a spring but was, in fact, genuine weakness, and the trader must immediately exit the position. Another excellent entry point is after a secondary test in the latter part of an accumulation range. A successful secondary test is a dip toward the low of the selling climax that occurs on significantly diminished volume, proving that supply is exhausted. When a trader buys after this confirmation, his stop is placed just below the low of that secondary test. The logic is the same. The trade is based on the evidence that selling pressure has disappeared. A move below the low of this successful test would contradict that evidence and thus invalidate the reason for the trade. The next scenario is buying on a breakout. After a stock completes its jump across the creek, moving out of its accumulation range, and then completes a successful backup to the edge of the creek, the trader has an excellent low-risk entry point. The stop loss is placed just below the low of this pullback, which is often the former resistance line of the trading range now acting as new support. If the breakout is genuine, this new support level should hold. A failure of this level, with the price falling back into the old trading range, would be a strong indication that the breakout has failed, and the position must be closed. Finally, let us consider buying during an established uptrend. After the initial breakout, a healthy trend will proceed in a series of advances and reactions. Opportunities to enter a long position often occur during periods of reaccumulation, or stepping stones, or at the conclusion of a normal, healthy pullback. In these cases, the stop loss is placed just below the low of the most recent reaction. A healthy uptrend is defined by a series of higher highs and higher lows. A decline that violates the low of the previous reaction breaks this pattern and is the first sign that the trend may be ending. The stop placed at this level ensures that the trader exits the position as soon as the stock's bullish character comes into question. Now let us examine the rules for placing stops on short positions, which are trades initiated with the expectation of a price decline. The logic is the perfect mirror image of that for long positions. In every case, the stop is placed just above a valid point of technical resistance. The best opportunities to sell short occur at the end of a period of distribution. The most powerful of these is after an upthrust. An upthrust is the final manipulative move above the resistance of a trading range, designed to trap bulls at the top. When a trader sells short in confirmation of an upthrust, that is, after the price has failed to hold its gains and has fallen back into the trading range, the stop-loss order is placed just above the extreme high of the upthrust itself. The thesis for the short sale is that the breakout was false and that heavy distribution occurred at that high. If the price were to subsequently rally and move above the high of the upthrust, this thesis would be proven wrong, and the short position must be immediately covered. Another excellent short-selling opportunity comes after a secondary test of the high of a buying climax, especially if this test occurs on lower volume, indicating that buying demand is exhausted. When selling short after this sign of weakness, the stop is placed just above the high of this secondary test. The next scenario is selling on a breakdown. After a stock falls through the ice, breaking the support of its distribution range, it will often experience a feeble rally back to the underside of the old support line. This is the last point of supply, and it is an excellent low-risk point to initiate a short sale. The stop loss is placed just above the high of this rally, which is the old support level now acting as new resistance. If the breakdown is genuine, the price should not be able to reclaim its old trading range. A move back above this level would signal that the breakdown was false and the short position must be covered. Finally, when selling short during an established downtrend, the stop is placed just above the high of the most recent rally. A healthy downtrend is defined by a series of lower lows and lower highs. A rally that violates the high of the previous rally breaks this bearish pattern and is the first sign that the trend may be reversing. Placing the stop at this logical point ensures the trader exits his short position as soon as the stock's weak character is no longer in evidence. In every single one of these scenarios, for both long and short positions, the stop loss is placed not at an arbitrary price, but at a specific technical point that is directly linked to the logic of the trade. The final piece of this strategic puzzle is the integration of the stop-loss placement with the potential profit of the trade. This brings us back to rule number 4. The anticipated profit must be at least 3 times the risk. Before any trade is even considered, the Wyckoff analyst must perform this critical calculation. The process is a 3-step sequence. First, based on a thorough analysis of the chart, the trader identifies a potential trade and the logical entry point. Second, he identifies the logical danger point for that trade, as we have just discussed, and determines where his initial stop loss must be placed. The distance in points between his entry price and his stop loss price constitutes his risk. Third, he must determine the potential reward. This is done by projecting a logical price objective for the move. The most scientific way to do this, according to Wyckoff, is by using the point and figure counting method to measure the cause that has been built during the accumulation or distribution phase. This count provides a reasonable estimate of how far the subsequent move can be expected to travel. The distance in points between his entry price and this price objective constitutes his anticipated reward. Finally, he compares the two figures. If the anticipated reward is not at least 3 times the size of his defined risk, the trade must be passed over. It does not matter how promising the setup appears. If the risk/reward ratio is unfavorable, the professional trader moves on and waits for a better opportunity. This single discipline is the mathematical foundation of long-term trading success. It ensures that the profits from the winning trades will be large enough to overwhelm the small, controlled losses from the losing trades. It frames the stop loss not as an afterthought, but as an integral and indispensable part of the trade selection process itself. It is the denominator in the all-important risk-to-reward equation that lies at the very heart of trading as a business. Once a trader has mastered the foundational principles of capital preservation and the art of placing a correct, logical initial stop loss, the nature of his work shifts. The initial phase is defensive. It is a discipline focused on survival and the prevention of catastrophic loss. But after a trade is initiated and begins to move in a favorable direction, the trader must transition from a defensive to an offensive mindset. His new objective is to manage the position in a way that maximizes the potential gain while systematically protecting the profits that have already accrued. This is a profound psychological challenge. The public's natural tendency is to snatch a small profit with nervous haste, driven by the fear that it will disappear. The professional, however, understands that the greatest profits come from riding a sustained trend for a substantial move. Richard Wyckoff's rules for managing a stop loss are designed to instill this professional discipline. They provide a logical, unemotional framework for letting profits run, while ensuring that a significant portion of those profits is never given back to the market. The cornerstone of this profit protection strategy is the trailing stop loss. This is the mechanism by which a trader can patiently follow a trend for weeks or even months, surviving the inevitable normal reactions while systematically locking in gains. The method is logical and precise. In a healthy uptrend, which is defined by a series of higher highs and higher lows, the rule is as follows. After the stock makes a new high and then completes a normal, healthy reaction on diminished volume, the stop-loss order should be moved up to a point just below the extreme low of that reaction. This process is then repeated for the duration of the trend. Each time the stock surges to a new high and successfully completes a subsequent pullback, the stop is trailed up behind it, placed just under the new higher level of support. The psychology and logic behind this technique are flawless. By placing the stop below the most recent reaction low, the trader gives the stock ample room to breathe. He is allowing for the normal, healthy pullbacks and consolidations that are a necessary part of any sustained advance. He is not choked out of his position by the meaningless minor fluctuations. At the same time, this method forces the market to prove that the trend is definitively over. For a healthy uptrend to be broken, the stock must, by definition, violate the low of the previous reaction. By placing his stop at that precise technical point, the trader ensures that he will be automatically exited from his position at the first logical sign that the trend's primary structure has been compromised. This removes the emotional turmoil and guesswork from the decision of when to take a profit. The trader does not have to wonder if a reaction is minor or major. His trailing stop makes the decision for him, based on the market's own action. A critical milestone in the management of any trade is the first move of the stop-loss order to the break-even point. After a trade has been entered and has moved favorably by a sufficient amount, the first objective is to move the stop to a price that covers the original entry price plus all commissions and taxes. This creates what is commonly known as a risk-free trade. The psychological benefit of this single action cannot be overstated. Once the initial capital is no longer at risk, the trader's mindset is liberated. He's no longer playing with his own hard-earned capital, but with the market's money. This clears his mind of the fear of loss and allows him to focus with much greater objectivity on the primary task at hand, managing his accumulating profit. This single step is a crucial part of transitioning from a defensive posture to an offensive one. As a profitable trend matures, the trader is faced with a strategic decision on how to ultimately exit the trade. Wyckoff acknowledged two primary methods. The first is a manual exit where the trader closes the position himself when the chart shows a clear, logical sign that the advance is culminating. This could be a buying climax, an upthrust, or any other sign of significant distribution. The advantage of this approach is that it may allow the trader to secure a price that is closer to the absolute high of the move. The disadvantage is that it requires a high degree of skill and is subject to emotional error. A trader may misinterpret a simple consolidation as a top and exit too early, missing out on a further substantial advance. The second method is the automatic exit, which is simply allowing the trailing stop-loss to do its job. The trader continues to trail his stop up under each successive reaction low and remains in the position until the trend finally breaks and the stop is triggered. The advantage of this approach is its mechanical discipline. It removes emotion from the exit decision entirely. While this method will, by definition, never capture the absolute high of the move, it guarantees that the trader will capture a very substantial portion of the overall trend. For most traders, especially those who are still developing their judgment, this systematic, unemotional approach is the far superior choice. It is the embodiment of Wyckoff's principle to let the profits run. Wyckoff also discussed several advanced professional-level concepts related to the use of stops. One is the practice of placing stop-loss orders at odd fractions. He observed that the public and many amateur traders have a strong tendency to place their orders at even, whole numbers or at the half-point marks. Floor traders and specialists, knowing this, could at times be tempted to briefly push a stock to these obvious levels to trigger the clusters of stops. To counteract this, Wyckoff advocated for placing stops at the less common fractions, such as 1/8, 3/8, 5/8, or 7/8. Placing a stop at 62 and 7/8 instead of at 63 provides a small but meaningful buffer that can often prevent a position from being shaken out on a meaningless dip. He also warned of the dangers of using stops in thinly traded markets. In stocks with a small floating supply and a wide spread between the bid and asked prices, a stop order may not be executed cleanly. A stop placed at 70 could be executed at 69 or even 68 in a fast market, as the price gaps down between trades. For this reason, he strongly advised that traders, especially those who rely on close stops, should confine their operations to the active liquid market leaders where executions are swift and reliable. For the highly experienced operator, Wyckoff also described an advanced technique known as the double stop for reversing a position. For example, if a trader is long 100 shares of a stock at 61, and he determines that the critical support level is at 59 3/4, he might reason that a break of this level not only invalidates his long position, but is also a signal to initiate a new short position. In this case, he would place an order to sell 200 shares at 59 3/4 stop. If triggered, this single order would close out his 100 share long position and simultaneously put him short 100 shares, instantly reversing his stance in the market. This is a tool for the agile expert trader, but it illustrates the flexibility of mind that Wyckoff sought to cultivate. For those who wish to truly master the lessons discussed here, it is essential to study them from the source. Please take note of a unique new edition of Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds, by Max Davidson. It has been meticulously adapted for the modern trader, complete with explanations that make Wyckoff's timeless wisdom more accessible than ever. For anyone who wants to truly absorb the lessons we are discussing, this adapted edition is an indispensable part of your library. The link to this book is located in the description of this video. In conclusion, the stop-loss order in the hands of a Wyckoff analyst is far more than a simple safety net. It is a complete system for the professional management of capital and risk. The philosophy of the stop-loss instills the business-like mindset necessary for survival. The art of its initial placement, based on the logic of the chart, ensures that trades are only taken when the odds are heavily in the trader's favor. And the science of its management, through the disciplined use of the trailing stop, provides the mechanism for capturing the large trend-following profits that are the hallmark of all great operators. The mastery of this single tool, its philosophy, its placement, and its management, is the single most important step in the journey from being an amateur gambler to a professional market operator, one who can survive and thrive in the financial markets for the long term.